If you're investing in a vacation rental and ignoring your cap rate, you might be missing the most important number on your spreadsheet. Cap rate is one of the simplest, most powerful ways to evaluate if your short-term rental will actually turn into a profit. But what is good cap rate for Airbnb? And how do you actually calculate it? Let's break it all down. In this video, we'll walk through what a cap rate is, how to calculate it, and what numbers you should aim for as a short-term rental investor. We'll also compare cap rates across US cities and unpack why higher isn't always better. By the end, you'll know how to use cap rates like a pro to make smarter investment decisions. Cap rate, or capitalization rate, is a metric that helps real estate investors estimate the potential return on an investment property. It tells you what percentage of the property's value you can expect to earn in income every year, not including financial costs. Think of cap rate as the baseline performance indicator for any income-generating property. It compares the expected annual net operating income, or NOI, against the market value of the property. This number is especially useful when comparing different Airbnb markets or deciding between two potential investments. While gross income numbers can look great on paper, the cap rate gives you a more realistic, apples-to-apples view of performance. To calculate cap rate, you'll need two things: your expected net operating income, or NOI, and the current market value of the property. NOI is your gross income from bookings minus all your operating expenses. This includes everything from cleaning fees and property management to taxes, insurance, and utilities. It does not include your mortgage payments or financial costs. Cap rate is always calculated before debt service. So the formula looks like this. Cap rate equals net operating income divided by property value times 100. Let's say your Airbnb generates $60,000 in annual gross income. After deducting $20,000 in operating expenses, your NOI is $40,000. If the home is valued at $500,000, your cap rate would be $40,000 divided by $500,000 times 100, which equals 8%. That means you're earning 8% of the property's value in profit every year, and that's a number worth knowing. Here's where things get interesting. Cap rates can vary dramatically depending on where you're investing and what kind of rental you're running. In general, a cap rate between 5 and 8% is considered solid for short-term rental properties. According to AirDNA data, short-term rentals in the US average a 6.2% cap rate. Some investors target higher returns, especially in riskier or emerging markets. Others are willing to accept low cap rates in exchange for more stable or desirable locations. Ultimately, a good cap rate is one that aligns with your goals, your risk tolerance, and your market. And remember, a strong cap rate doesn't automatically mean a great investment. It should be part of a bigger picture that includes local regulations, market trends, and your long-term strategy. You might assume that a higher cap rate is always better, but that's not necessarily true. High cap rates often show up in markets with lower property values and higher validity. These areas might be riskier due to regulation, uncertainty, seasonal demand swings, or local economic conditions. On the flip side, high-demand vacation destinations or stable metro areas tend to have lower cap rates. Investors are often willing to accept a smaller return in exchange for a safer, more predictable rental market. So while a 10% cap rate might sound amazing, you'll want to dig into the data. Ask yourself, what's driving that number? Can it be sustained over time? A cap rate should be a starting point, not the only factor in your decision-making process. Want to know how your market stacks up? AirDNA looked at cap rates in popular US cities using our own Rentalizer tool, which calculates short-term rental cap rates for any address in the world. Some of the highest cap rates are in places like Gatlinburg, Tennessee, a top-performing mountain market, Blue Ridge, Georgia, strong income potential with lower property costs, Poconos, Pennsylvania, consistently high returns for nature-based rentals. Meanwhile, markets like Los Angeles, San Francisco, and New York City have much lower cap rates. Why? Higher property values and stricter regulations tend to compress returns. Cap rates can also vary by property size, seasonality, and amenities offered. That's why AirDNA's rental calculator lets you customize your comparable properties based on your property type, number of bedrooms, and listing features to get an accurate projection. Cap rate is one of the most important tools in your Airbnb investing toolkit. It tells you how hard your money is working and helps you compare investment opportunities with clarity and confidence. So before you make your next move, run the numbers. Use AirDNA's rental calculator, understand the market, and make data your competitive advantage. If this video helped you, make sure to subscribe and give this video a thumbs up.